Hello everyone! Welcome back to our YouTube channel and hope you're enjoying our lessons and they help you understand the world of finance and accounting a bit better. In today's lesson we will summarize a few things learned in the previous videos and dive deeper into how receivables, payables and cash interact within the business. These elements are crucial for management financial flow, and smart handling of them can keep a company running, even without any starting funds, or if you are facing some temporary problems with cash. In our previous videos, we've always started with some amount of cash in the business. But can a business operate with no cash and ultimately no equity? Surprisingly, yes. Imagine you've made a bad investment decision or lost your starting funds. Yes, that may happen, it's life, full of surprises. You are left with nothing on the balance sheet. You have zero assets and you have zero liabilities plus equity. What can you do? Can you still operate? The answer is yes, thanks to trust and good relationships. Let's say you still want to continue running your business and buy 5 apples at $10 each, totaling $50. But you don't have the money. Fortunately, based on your history, your supplier trusts you and agrees to sell the apples on credit. So you talk to him and get your inventory. Now the balance sheet changes. In assets you have inventory of $50 and liabilities you record payables of $50 which you owe to your suppliers for the apples. The balance sheet balances. The transaction works because the supplier gave you assets upfront in exchange for a promise to pay later. And you are still running with no cash on your balance sheet. This is the essence of trade payables. Now, to run the business, you sell the 5 apples. Here there are 2 possible outcomes. Option 1. Immediate payment of your customer. Customer pays $50 in cash and your balance sheet changes as follows. You record cash of $50 in your assets and your payables still stay at $50. Balance sheet balances. Option 2. Delayed payment from your customer. Customer asks to pay later and you agree to that because you trust your customer. Your balance sheet changes as follows. On the asset side, you record receivables of $50 and on the liability side, your payables still stay at $50 and the balance sheet balances. For the second option, eventually your customer pays you. You convert receivables into cash. So you record cash of $50 and your liabilities stay as payables of $50 as well. In either case, your business has $50 in cash on the balance sheet, but you still haven't spent a single dollar in advance. You're running the operations, and the balance sheet still balances. Now you can pay your supplier. You transfer cash decreasing its balance to zero, and the payables are settled too. Your supplier is happy, you fulfilled the promise and didn't disappoint. Now you again have a clean balance sheet which balances assets of $0 and liabilities of $0. You have now completed a full operational cycle without having started with any funds, buying and selling goods, receiving the payment and making the payment. The only starting funds you had was the relationship with the supplier and the customer. But please note, in this case it is crucial that the delay of your payment to the supplier is longer than the waiting time for the payment from the customer. Otherwise you will run into trouble and will not have money to pay the supplier in time. Then your relationship and trust will be damaged, and you don't want to do that. You may ask, why do all these transactions to end up where we have started? No cash, no assets, no equity, everything in zero. Well, it's a very good question. Let's take this one step further. Normally, the purpose of the business is to generate profits. Imagine you bought the apples on credit for $50 but sold them for $60, also on credit. How will the balance sheet look like now? So you have receivables now of $60 because you sold the apples for $60, but the liabilities are staying as payables of $50. The balance sheet doesn't balance. Let's fix it. So now you have assets of $60 and liabilities of $50. Your assets are higher than your liabilities by $10. Why? For the first time, you have earned a profit, $10. Profits are yours and belong to you. And the ultimate target of almost all businesses, generating profits and creating added value. Remember where we were placing the resources we own? correct, in equity. So the earned profits are going there too. And yes, you can earn profits without moving cash around, as long as you expect it to become cash in the future. As a result, we increase the equity and the balance sheet looks like this. You have the receivables of $60, you have the payables of $50, and now you record $10 in equity. Your total assets are $60, and total equity and liabilities are also $60, and the balance sheet balances. Now the customer pays you $60. We remove the receivables of $60 and record the cash of $60. Payables still stay at $50. Our profits in equity also stay at $10. Then you pay your supplier $50. Cash decreases by $50 to $10, and liabilities decrease by the same $50 and become zero as we settle our debts. Now you have an updated balance sheet, $10 in cash, no debts, and all of it is pure profit which sits in equity of $10. And of course, balance sheet balance. We just demonstrated that you can operate, sell, and generate profit without investing a single dollar by relying on trusted relationships. If the supplier hadn't trusted you, you couldn't have bought the apples. If the customer hadn't paid on time, you couldn't pay your supplier. Timing is everything. Ideally, you should receive customer payments before supplier payments are due to avoid running into trouble. The elements of the balance sheet that we've just discussed, inventory, receivables, and payables, are the key components of a so-called net working capital, or simply working capital. To calculate it, you add the operational assets and subtract operational liabilities. Let's include a few examples that could be the result depending on whether we have higher assets or higher liabilities. If they are equal, you have neutral working capital. If liabilities are higher, you have it negative. If assets are higher, positive. In a lot of cases, negative working capital is preferred, as it means that your suppliers are financing your business and you don't need extra cash to finance your customers. Your suppliers wait longer for payment than you wait your customers to pay. Management of net working capital has a direct and very important impact on the cash flows of the business. We will learn more about working capital in later videos, don't worry. Cool guys! We have achieved quite an accomplishment today, even touching base on profits and working capital. Let's wrap up our third lesson. Our takeaways are: you can start and run a business without initial cash. Payables allow you to buy goods on credit. Receivables are promises from customers to pay later. Good timing and relationships are essential. You can generate profit even with zero upfront investment. Thank you for watching, guys. If you found this video insightful, don't forget to like, subscribe, and hit the notification icon. See you in the next lesson where we'll continue exploring the world of finance.